Silver's price is lying, and the lease market is telling the truth. Because this breakout isn't sentiment, it's stress showing up in the one place that only insiders bother to watch. Silver just pushed into levels that force the entire ecosystem to react, not opine. And the most important detail isn't the headline print. It's the cost of borrowing real metal quietly going vertical behind the curtain. And if you stay with me, I'm going to give you a simple 2-scenario map for the next week or two, the level that matters more than any influencer target, and the checklist that tells you whether this move is about to cool off or snap into something nastier. Here's the weird part. When markets are healthy, the paper story and the physical story don't fight. They rhyme. The screen price goes up, borrowing costs stay boring, spreads behave, ETFs track, and everyone feels clever. But when silver breaks pattern, the market starts doing wrong things that confuse people who only watch the candle chart, like silver-linked vehicles dropping harder than spot in the middle of a supposedly bullish frenzy, like spreads tightening when they should relax, like borrow rates spiking when the crowd is distracted by a round number headline. And that's where the real pressure starts. Because it tells you the move isn't only about demand, it's about availability, timing, and who gets squeezed by settlement reality. Let's anchor what just happened without getting hypnotized by the number. Silver didn't just drift higher. It accelerated. It ran through prior resistance zones like they were paper barricades. It printed around that psychologically radioactive $100 area on major futures venues. And it did it fast. So fast that even people who hate silver had to look up from their macro dashboards and ask, wait, what? That's not normal. Not for a market that usually lives on steady industrial demand, cautious hedging, and periodic speculative flares. This was a regime change in behavior. And the second you get a regime change in behavior, your job as a retail investor isn't to predict the top. Your job is to identify the mechanism that's driving the flow, because flows don't care about your opinion. But here's the trap. The mainstream will frame this as a simple story. Geopolitics, rate cuts, safe haven, speculative mania. Pick your favorite. They're not totally wrong, but they're incomplete. And incomplete stories get you chopped up. Because if you treat this like a clean trend, you'll panic on the first violent pullback. And if you treat it like a bubble, you'll miss the part where the plumbing force is buying even when everyone is scared. The next detail is what flips the whole setup. The hidden detail is the lease rate. Think of a lease rate as the rent you pay to borrow physical silver for a short period, days, weeks, months, so you can meet delivery needs, fulfill industrial demand, manage inventory timing, or hedge a book without owning the metal outright. When the market is loose, that rent is boring. It's background noise. When the market is tight, that rent spikes because lenders don't want to part with metal unless they get paid. And borrowers are willing to pay because the alternative is worse, failing to deliver, missing production, or getting caught short in a market that's moving against you. In other words, lease rates are an honesty meter for physical stress. Price can be pushed around by positioning. Lease rates are harder to fake because they were tied to the availability of metal at specific times. And that's why this matters right now, this week, not someday. Because when lease rates jump at the same time price breaks pattern, it's telling you this isn't just more buyers showing up, it's buyers showing up with a clock. And when buyers show up with a clock, the entire market structure changes. But that's not the part most people see. Most people see the headline number and then they do the two worst things in finance. They either chase or they freeze. So let's slow down for 10 seconds, just enough to get the mechanics, and then speed up again, because the calendar is about to matter. Here's the plain English version. Silver is traded in multiple layers. There's spot and physical bars and coins and industrial feedstock. There's futures contracts that can be closed out for cash or carried to delivery. There are ETFs and ETPs that promise exposure but come with their own creation, redemption mechanics, and their own risk of dislocation when liquidity gets ugly. There are bullion banks and dealers who make markets and hedge inventory. And there are industrial buyers who don't care about your chart patterns because their factory line doesn't accept excuses. When everything is calm, these layers line up. When stress hits, they separate. And when they separate, the separation itself becomes a signal. So if you want proof without relying on one magic indicator, you stack it. Mechanism, then symptom, then structure, then flow, then what happens next. Proof point number 1 is the behavior shift. Silver didn't just rise. It broke a pattern and held long enough that the market couldn't instantly mean revert it. That alone changes how algorithms, trend followers, and hedgers behave. Because once you get a clean breakout, you get follow-through buying from systems that do not negotiate. But a breakout isn't enough. Plenty of breakouts fail. The second proof point is the wrong behavior around the price. Dislocations and violent moves in silver-linked vehicles, where you see things like ETFs getting hit far harder than the underlying move would imply. That's not just weak hands. That's often a sign of leverage getting shaken out, forced selling into thin liquidity, and liquidity providers widening spreads because they don't trust their ability to hedge smoothly. And when liquidity providers step back, price doesn't move like a gentle escalator, it moves like a trap door. And that's where the pressure starts. Proof point number 3 is the lease rate. Again, you don't need to memorize formulas. Just remember the intuition. If it's suddenly expensive to borrow silver, the market is telling you that immediate availability matters. That can happen because of genuine physical tightness. It can happen because metal is there but not free-floating, allocated, encumbered, earmarked, already spoken for. It can happen because lenders are hoarding inventory as a risk management response. Different causes, same symptom. The rent goes up. And when rent goes up during a breakout, it's telling you the move has teeth. Proof point number 4 is what happens at the front end of the curve and in the spreads, because spreads are where timing shows up. In normal contango, the future is priced higher than spot because carrying metal costs money, storage, insurance, financing. In stress, you can get backwardation or near backwardation behavior. The front month gets bid, nearby tightens versus deferred, and the market starts screaming, "I want it now." And that's not a Reddit slogan, that's market structure. And when the front tightens, it forces participants to do things they don't want to do. Shorts who assumed they could roll cheaply suddenly face expensive rolls. Dealers who assumed they could borrow metal cheaply suddenly face punitive borrow costs. Anyone who promised delivery has to either source metal, pay up to borrow it, or buy back their short exposure into a rising tape. That's reflexivity. That's not conspiracy. That's incentives. Proof point number 5 is delivery behavior and settlement pressure. A futures contract is often traded like a bet, but it has a door that opens into reality, delivery. When a market sees higher delivery demand relative to expectations, it forces the system to move physical metal or cash settle positions that were never meant to meet a truck. And even if you don't have every inventory number memorized, the existence of heavy delivery chatter matters because it changes how cautious participants behave. They raise margins, they reduce lending, they widen spreads, and that feedback loop can lift lease rates and squeeze shorts. That's why the lease market matters more than your favorite moving average. But here's the most important layer. The why now is the calendar. And the calendar doesn't care what you believe. When you get month-end, quarter-end, delivery windows, option expiries, and thin liquidity pockets, especially around weekends and risk events, markets can gap. They can gap even if the thesis is correct. They can gap against you in a way that makes you feel stupid for being early or late. And that's exactly how volatility is used as a weapon. Not by villains in a room, by the structure of the game. Dealers hedge exposures into expiries, funds rebalance into month-end. Risk managers tighten limits into uncertainty. Liquidity thins at the worst possible time, and that creates air pockets, those sudden vertical moves that feel like manipulation but are often just the absence of counterparties. Because if this one level breaks, the math changes. Let's talk about that level, but in a way that keeps you sane. You don't need a perfect target, you need a framework. The framework is this: identify the breakout shelf, identify the prior high zone, and identify the first area where the move would be proven wrong rather than merely noisy. Right now, the breakout shelf is the zone just below the round number shock level, call it the last consolidation area before the vertical leg. That is the area where dip buyers have to show up if this is a real structural move. The prior high zone is the last place where silver repeatedly failed before this break. If price comes back under that zone and stays there, it tells you the breakout was a head fake, and the invalidation area is not down a little. It is a clean breakdown back into the prior range, with follow-through selling and lease rates cooling at the same time. That combination matters. Price down, lease rates down, spreads relaxing. Because if price pulls back but lease rates stay elevated, that's not weakness. That can be a reset, a retest, a reload. And that's where the real pressure starts, because it means the physical market didn't loosen just because the chart took a breath. Now, I can already hear the counterpoint, and you should hear it too, because it's the difference between being prepared and being emotionally manipulated. The counterpoint is, this is just speculative froth. It's a mania. ETFs are blowing out because the crowd is stampeding and then getting rugged. Lease rate chatter is overblown. The market is too small, too volatile, too easy to whip around. And you know what? Parts of that are valid. Silver is famously violent. It can rip your face off in both directions. It can do a 10% down day and then a 12% up day and make both bulls and bears look delusional. And that's why the psychology shield is non-negotiable. If you don't build it, you'll lose money even if you're right, because you'll act at the worst times. Here's the shield. Separate trend signal from noise. Trend signal is structure. Breakouts that hold, spreads that stay tight, borrow markets that stay stressed, and dips that get bought quickly without collapsing lease rates. Noise is the emotional theater, a scary headline, a viral thread, a sudden downtick at a thin hour, or a one-day ETF move that's more about liquidity than fundamentals. The market will try to convince you that noise is signal, because noise is what triggers panic. And panic is what provides cheap inventory to people who understand structure. So when the move whips around, because it will, your job is not to guess each wiggle. Your job is to watch the structure indicators that sit underneath the wiggles. Lease rates, front-end spreads, delivery chatter, physical premiums and availability, and the speed of dip buying. Those are harder to fake. Those are harder to narrate away. And the next detail is what flips the whole setup. What happens when paper demand meets physical timing constraints? Imagine you're a manufacturer who needs silver feedstock. You don't care if silver is overbought. You care that your procurement team can source metal without paying an emergency premium. Now, imagine you're a dealer or bullion bank who has promised clients liquidity and pricing. You don't care about the internet argument. You care whether you can borrow metal to make delivery or hedge inventory without getting crushed by financing costs. Now imagine you're a short in futures who assumed rolling would be cheap and plentiful. You don't care about the moral of the story. You care whether your margin requirement just doubled while the borrow market tightened and the tape moved against you. These are not feelings. These are forced actions. And when forced actions stack, they create vertical moves. That's why a lease rate spike is not trivia. It's a pressure gauge. Let's do a quick pattern interrupt, a simple calculation in words, because it makes the point. If borrowing metal costs, say, low single digits annualized in normal times, it's annoying but manageable. If borrowing metal costs suddenly jump into double digits annualized, that becomes a real P&L line item. And if it jumps beyond that, it becomes a stop doing this signal for anyone who relies on borrowing as a routine operational tool. That changes behavior. It reduces lending. It reduces willingness to short. It increases the urgency to source physical or close paper exposure. And that's why lease rates can front-run visible panic. They're the first place the market admits scarcity, because people who live in the plumbing respond before the crowd does. But what about supply? Can't miners just crank production? That's the next trap. Silver supply isn't a faucet you twist. A large portion of silver production is byproduct, tied to other mining economics. So even if silver screams higher, you don't instantly get a flood of new metal. Add refining and logistics bottlenecks. Add recycling constraints. Add the fact that industrial demand doesn't politely pause, and short-term tightness expresses itself in exactly the places we're discussing. Borrow costs, spreads, premiums, and delivery stress. That's why this feels different when it breaks. Because the supply chain is slow, but the paper market is fast. When the fast layer runs ahead of the slow layer, the bridge between them, leasing, inventory, and delivery, starts to creak. And that creaking is audible if you listen in the right places. But that's not the part most people are watching. Most people are watching the headline and the round number, and round numbers are magnets. They attract both buyers and sellers. They attract profit-taking and they attract late chasing. They attract it can't go higher bravado. So here's what you need to expect. Emotionally, in the next week or two, you are going to see volatility designed to make you doubt your own eyes. You'll see sudden downdrafts that feel like the end. You'll see violent rebounds that feel like a trap. You'll see commentators shifting narratives in real time. One day it's safe haven, the next day it's bubble, the next day it's manipulation, the next day it's industrial boom. That narrative churn is not information, it's stimulus, and stimulus makes retail act. The way you resist is by pre-committing to a framework. Two scenarios, a base case and a squeeze case, and specific confirmation signals for each. Scenario one is the controlled pullback and retest. Price cools off after a vertical move. It comes back toward the breakout shelf. Liquidity looks scary for a moment. People call it a collapse. Then buyers show up in size. Not because they're emotional, but because the structure still supports it. Lease rates stay firm, spreads stay tight, and physical availability doesn't magically loosen. In this scenario, silver can look weak for hours or even a couple days while actually building strength. The confirmation is the retest holding and then reclaiming key closes, with the borrow market not easing materially. Scenario two is the continuation, squeeze, and gap risk. Price doesn't offer a neat pullback. It grinds higher, then jumps, often around thin liquidity, overnight sessions, pre-weekend, month-end rebalancing windows, or into an expiry. In that scenario, the pain point is not being wrong. The pain point is managing exposure and emotions in a market that can gap. The confirmation is lease rates staying elevated or rising further, spreads tightening at the front, and dips getting bought instantly, almost rudely, like the market is starving for offers. In that scenario, the risk is also higher. You can get air pockets down as well as up, because once a market goes vertical, it attracts both forced buying and opportunistic selling. So you don't worship the squeeze scenario, you respect it. And you build risk rules that keep you from doing the two classic retail mistakes, oversizing at the highs and rage selling the first sharp down candle. Now let's get concrete about what to watch next, because this is where trust is earned. First, watch the breakout shelf. If silver holds above the last pre-vertical consolidation zone on a closing basis after a pullback, that's constructive. If it slices back under that shelf and stays there for more than a brief flush, that's caution. Second, watch the prior range. If price fully re-enters the old range and starts accepting lower levels, meaning bounces are weak and sellers control closes, that is your warning that the pattern break may be failing. Third, watch the borrow market. If price pulls back, but lease rates remain elevated relative to recent history, that can imply physical tightness hasn't relaxed. If both price and lease rates collapse together, that's a different message. The stress is easing, at least temporarily. Fourth, watch spreads and the front end of the curve. If nearby months stay bid and the market continues to pay up for immediacy, that supports the stress thesis. If spreads relax and contango reasserts cleanly while price stalls, that's cooling. Fifth, watch physical signals you can actually observe. Premiums, availability, delivery lead times, the tone from industrial procurement, and the consistency of buy-the-dip behavior. None of these alone is perfect. Together, they form a picture. Proof stacking is how you avoid being seduced by one dramatic indicator. And that's where the pressure starts. Because when multiple layers agree, you're not trading a story. You're trading a structure. Let's address the institution skeptic angle without going off the rails, because this crowd hates being lied to, and they should. Markets have incentives. Dealers hedge. Funds manage optics. Banks manage risk. Governments shape narratives. That's not conspiracy. That's normal. So when people say they're suppressing it, the safer, more accurate translation is there are participants with strong incentives to dampen volatility, manage collateral stress, and avoid disorderly price discovery. Sometimes that means supplying liquidity. Sometimes it means stepping away, which ironically creates the disorder. Sometimes it means leaning on paper tools because paper is easier to scale than physical. But when physical timing constraints bite, when lease rates spike, when spreads tighten, when delivery pressure increases, paper can't fully override that without a cost. The cost shows up as higher rent for metal, higher premiums, and higher volatility. And volatility is the tax everyone pays when the market is trying to reconcile two realities at once. Now, the calendar trigger again, because it's the quiet accelerant. Month-end and delivery windows force decisions. Option expiries can turn hedging into a reflexive feedback loop, where dealers have to buy as price rises and sell as price falls to stay hedged, amplifying moves. If you see silver hovering near a big strike-rich zone, those round numbers that everyone clusters around, gamma dynamics can make the tape feel haunted. It can pin, it can snap, it can reverse in minutes. That doesn't mean the thesis is wrong, it means the path is violent. So when you watch the next week, don't just watch direction. Watch liquidity. Watch whether moves happen in thin hours. Watch whether gaps appear. Watch whether bounces are reluctant or aggressive. Reluctant bounces are dead cat. Aggressive bounces are structural demand. And if you're wondering why I keep talking about aggressive, it's because that's what forced flows look like. They don't negotiate. They hit offers. They don't wait for your comfort. But here's the part that keeps you out of trouble. You do not need to be a hero. You do not need to call the exact top or bottom. You need to avoid getting emotionally drafted into someone else's time horizon. If you're a retail investor with a macro lens, your edge is patience and structure. Your enemy is impulse, and volatility will try to recruit your impulse. It will whisper, "You're missing it," on the way up, and "you're stupid" on the way down. Ignore both. Build a plan that respects two truths at once. Silver can be structurally tight and still crash 15% in a week, and silver can look overextended and still rip higher because the borrow market and spreads are forcing behavior. That's why we use scenarios. That's why we watch confirmation signals instead of vibes. Now, let's talk targets without turning this into a carnival. Targets are not promises. They're reference points where behavior tends to change. The first target zone is always the next round number magnet above the breakout, because that's where profit taking and new hedging tend to cluster. The second target zone is the measured move extension from the breakout shelf. Take the height of the prior range and project it upward. You don't need exact decimals. You need the concept. The third target zone is where momentum typically exhausts in silver. Parabolic acceleration paired with widening intraday ranges and more frequent failed breakouts on shorter time frames. When you see that combination while lease rates stop rising, that's often a sign the squeeze phase is transitioning into a digestion phase. The invalidation is simpler. A decisive breakdown back into the prior range that holds for multiple closes, coupled with easing borrow stress and relaxing spreads. That combination says the market is no longer paying for immediacy. If that happens, you respect it. You don't argue with it. And the checklist for next week is straightforward. 1, does price hold the breakout shelf on a retest, or does it slice through like it never mattered? 2, do lease rates stay elevated relative to the recent baseline, or do they cool off sharply? 3, do front-end spreads remain tight, signaling urgency, or do they normalize quickly? 4, Do dips get bought fast and aggressively, or do bounces feel weak and apologetic? 5. Does volatility compress after big moves, or does it keep expanding, signaling stress is still feeding on itself? If you track those 5, you'll be ahead of 95% of the commentary, because commentary reacts to price. Structure explains price. And here's the subtle CTA, because the right audience for this isn't T people hunting dopamine, it's S people who want to see what S actually happening under the hood. If you're the kind of investor who'd rather track borrow stress and spreads than chase a headline, you're already in the right room, and you should keep building that habit with us, because this market is going to try to separate the tourists from the disciplined. Final reminder, before we land this plane, price can whip around violently even if the thesis is correct. That is not a contradiction. That is silver. Don't confuse a violent pullback with game over. Don't confuse a vertical spike with safe. Treat this like a high voltage market where structure matters more than emotion. Watch the lease market, watch the front end, watch the calendar, and when the mainstream tells you the story is simple, assume the mechanism is not, because the price can lie for a while. The spread and the rent usually can't.